Welcome back. So in this video, I'll be giving you a quick introduction about futures and how I trade options on futures. So first and foremost, what are futures? Futures are a derivative of the index. And the main difference is when you trade options on the index, like the SPX, or on the index ETF, like the SPY, you can only trade during market opening hours, which is 9:30 a.m. Eastern Time to 4 p.m. Eastern Time. Now, sometimes I like to enter the market before the market actually opens. So if I want to get in early, I will trade the futures, the S&P 500 futures, because the futures runs for almost 24 hours. It's about 23 and a half hours. So to be specific, the futures opening hours, as you can see over here, during the weekday, futures basically run from Monday to Friday. Okay, Monday to Friday. Weekend it's closed, right? But Monday to Friday it is open almost throughout, except the futures market closes for 15 minutes at 4:15 p.m. Eastern Time. So the stock market closes at 4 p.m. 15 minutes later, the futures market will close for only 15 minutes, which means from 4:15 to 4:30, it takes a short break. And then the futures market starts again. And it closes as well at 5:30 p.m. Eastern Time for half an hour. So basically, it only closes for 15 minutes plus half an hour. It only closes for 45 minutes. And the rest of the time, it is running throughout, okay? So if you're trading the S&P 500 futures, there are two products that you can trade. The first product is known as the S&P E-mini Futures. The ticker symbol would be /ES, which is what I have over here. Can you see E-mini S&P Index Futures? Recently, they have a new product which is called the S&P E-mini Micro Futures. And the ticker symbol would be /MES. So usually for people with bigger accounts, like you got a $100,000 account, $1 million account, you would trade the /ES. But for those of you who have got smaller accounts, like a $2,000 account, $3,000 account, then it's more affordable to trade the MES, and I'll show you why in a short while. Now, first of all, if you want to trade futures or trade options on futures, you got to get special permission from your broker. So you got to go to the account management section and apply for futures trading and option futures trading. And you've got to fill in a lot of forms, a lot of declarations, like I understand the risk, because it is very risky if you don't know what you're doing. So you got to know what you're doing, and then the broker will give you permission. Of course, they'll ask you how many years of experience do you have. If you say none, they say, I'm sorry, you can't trade this, right? So, you got to have experience for them to approve your account, okay? So, how do we trade futures options? Now, the way you trade it is actually the same as anything else. It's no difference, okay? As in, you look at the charts and you make the decisions based on the chart patterns. So the same thing applies. Now, I basically trade the futures I only use the futures to hedge, as a hedge to my investment portfolio. So, for example, if I find that the market is on a downtrend, is going on a bear market, and I don't want to wait for the market to open, I want to quickly hedge my position, I would usually buy bear put spreads on the S&P E-mini Futures or the micro futures. So in other words, I want to make sure that the futures, the chart, shows a downtrend, which is the same as the market, right? The 20 EMA crossing below the 40 EMA, right? Short-term downtrend, or the 50 moving average crossing below the 150 is a downtrend. Now, right now, if you look at the futures, the S&P futures, you can see that it is not a downtrend. It is still, obviously, an uptrend. So I'm not going to buy a bear put spread right now, but I'm going to just demonstrate it to you. So just imagine that the futures are on a downtrend, okay? And I'm going to show you how I buy bear put spreads on the futures. Now, before that, a few things you got to understand is that, so futures are contracts that also have expiry dates. So I repeat, you got a futures contract that has an expiry date and the option contract that also has an expiry date. So there are two expiry dates that you got to be aware of, okay? Now, let's take a look at the E-mini futures. Again, ticker symbol /ES. One of the things that you got to understand about this product is, you can see that, okay? It moves in 25-cent increments. So each move is, the smallest move will be 25 cents. Now, each 25 cents move represents $12.50. Whether you make $12.50 or you lose $12.50, all right? So a $1 move would be times 4, right? 25 cents times 4 is $1. So you multiply this by 4, what do you get? You get $50. Got it? So a $1 move in the E-mini futures represents a $50 profit or loss for you as a trader. $1 move equals $50. So the options contract, one contract would be multiplied by 50. Just remember that. One contract of E-mini futures multiplies by 50. Okay? Now, if you trade the micro futures, it'll be /MES. This is the smaller one for people with smaller accounts. Okay? Now, this animal over here, you can see that a $1 move times 4 would be $5. Right? 125 times 4 is $5. Okay? So for the E-mini micro futures, one options contract multiplied by 5. All right? Just remember that. Let me just write it down, and I want you to also note it down. By the way, this was actually covered in lesson 1, if you remember. Okay? In terms of contract size. So I'm going to repeat that. For the E-mini futures, one contract would be times 50. Remember that if you trade stocks and ETFs, it's always one contract is 100 shares, right? It's always times 100 shares. But for the E-mini futures, it's times 50, not times 100, times 50. And for the E-mini micro futures, one contract would be times 5. That's right. Okay, so that's the first thing that you gotta remember. Yeah. Okay. Now, so let's imagine that right now the futures are going on a downtrend. So I wanna take a short position. I want to buy a bear put spread. So if it keeps going down, I'm going to make money. So what do? I open up the trade tab. And I got to choose the date to expiration as usual. Now, but I mentioned initially that the futures itself has an expiry date. Okay. So you can see that these are the futures. So you've got the March contract, the June contract, the September contract, and the December contract. They're basically 4 contracts. Okay. Now you don't have to worry too much about this. You know why? Because the options that you see here, they are already based on the most recent month contract, which is the active contract. So we only care about the active contract. And the active contract, can you see the word active over there? In fact, if you just put active here, the active contract is the one, it is basically the March contract. So this is the futures contract that will expire in March. So all the options that we trade must expire before March. I repeat, the options contract must expire before the futures contract. Okay? So that's one thing you just bear in mind. All right. So don't worry. All right. The March contract 60 days. So all the option contracts we trade must be within 60 days. And these are the ones over here. Okay. Now, so let's imagine I want to go short right now. I'll take a bear put spread. I got to choose a DT, a date to expiration. How many days should I choose? Similar to the SPX, I'll choose about 25 to 30 days. Usually that's my style, okay? So let me look for 25 days to 30 days. Okay, so the closest would be this one. Can you see? So this expires in 25 days. And it expires on the second week of February. Now, notice that like this one expires on Monday. Can you see? This expires on Wednesday. Now, they don't give you the day here. When they don't give you the day, it's a Friday. So always remember, if there's no day, it's a Friday. Yeah. So this contract, this options contract, let's open it up, expires on the second week of February on a Friday. So let's look for it right now. Let's open it up. So February, second week, there's the first week of February, second week Friday. So this options contract expires on the 12th of February, Chinese New Year. Okay, 12th of February. So let's double check that's true. What day is it today? Today is the 18th of January. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25. There we go. 25 days. Exactly. Okay. Right. So 25 days. And it's going to expire on Chinese New Year, 12th of February. Okay. So that is the contract we're going to trade. So we're going to buy a put at the money and sell the put where we think it's going to go in 25 days. All right. So right now the market is at 3761. That's the current price of the futures, 3761. So let's look for 3761. 37. Okay, close enough. 3760. So we're gonna buy this put. So click ask buy. Boom. So if we just buy the put itself, it's gonna cost $76.50. Remember, times 50. So 76 times 50 is $3,825. Don't believe me? Click confirm and send. There you are. Right? The premium is the maximum loss, 3825. There you go. Right? That is the cost of buying the put. Really expensive. Oh, so expensive. $3,800 to just buy a put. I told you it's expensive. All right. So to make it cheaper, what do? We buy a put. We buy the put at 3760. And to make it cheaper, we sell a put at our target price, where we think the market is going to go down to. So in 25 days, right? 25 days, where will the market go down to if it goes down? There we are. Look at this figure over here. Can you see that? So based on current volatility, we expect the market to go up by 191 points or go down by 191 points in 25 days. So we expect in 25 days, market will drop by 191 points. So 3760 minus 191. Our target price in 25 days would be 3569. Let's round it off to 3570. Okay, so we're going to buy the 3760 put and sell the 3570 put. Okay, so this will cost us roughly right now the market price is 7625. This will cost us 7625. All right, and 3570, if we sell that put, how much can we make? 3570. Let's increase the strikes. Need more strikes. More strikes, baby. More strikes. There we are. 3570. If we sell this animal, it will give us 3275. So we collect two, we will collect 32.75. 32.75. So we collect this premium, which will help us to pay for this expensive put, lowering our cost. All right, so let's do that right now. So I'm going to click buy the 376 put. 3760 put. Buy this one. Click on ask. Buy. There we are. Then we're going to sell the 3570. This one. Hold the control key down and click bid. There we go. We've got a spread. Yep. So the spread's going to cost us 43.50 times 50 multiplied by 50. That's going to cost us 43.25 times 50. It's going to cost us $2,000 per contract. It's cheaper, right? But still pretty expensive. Yeah. Okay, so don't believe me? Click this. There we go. You see the cost of the trade, which is the maximum loss, is $2,000. Maximum profit, if it goes down and hits our profit target, we make 7 grand. So we're risking 2 grand to make 7 grand. That's not a bad deal, right? Risking $1 to make $3. Okay, and again, before you put the trade on, look at the analyze trade. Okay, so there we are. This is the profit and loss chart. So as usual, the one in green would be the profit and loss at expiration, and the one in purple would be the profit and loss based on this date over here that we can simulate when we're gonna get out. So what's the profit and loss when we're gonna exit? All right. Okay. So right now the market's at 3761. Okay. So our target is for the market to fall to 3570. So let's pull this to 3570. There. Okay. All right. So if the market drops, market drops down to our target, okay, and we hold it as it moves to expiration. Look at the purple line. The purple line is moving to the green line, okay. So when it's near 25 days, we're going to take profit and we're going to make about $7,000 if the market goes down. If the market doesn't go down, if the market goes up instead, we got to cut our loss. Because the market goes up, it means, hey, no longer downtrend, market's going back up. We got to cut our loss. Remember, as a trader, you got to have a profit target, you got to have a stop loss. So the moment it goes up, you have a mental stop loss. Like, okay, the moment it reaches a certain point, I got to cut my losses. It means that the market's not going down, it's going up, I got to get out. Don't hold it to expiration and lose everything. Get out early, salvage some of the premium left. So usually what I do is I find that if the market, instead of going down, market doesn't go down, but market goes up and it goes above the previous swing high, I would cut loss. Of course, like I said, I will only do this if the market's on a downtrend. The market is not on a downtrend now, it's on an uptrend. But I'm just giving an example, okay? So if the market goes above the previous swing high to say 3830, I'll cut my loss. Okay, so 3830 would be somewhere 3830, somewhere there. Yeah. So if the market goes up to 3830, I will get out. And I will not get out near expiration, I'll get out before expiration, right? So that I get some time value left in the option. So maybe, see, this expires on the 12th of February. So maybe by the 5th of February, if I find that market's not going down, I get out early, I won't lose the entire green. I'll lose the purple, which would be roughly, I'll lose 1423. Okay, I'll lose $1,423. But if I'm right and it goes down and I take profit nearer expiration, I could make 6 grand. or I could make 7 grand. And that's not a bad deal, right? So I'm risking $1,400 to make $6,000 to $7,000. That's risking $1 to make $5. Pretty good trade. Okay. So again, if losing $1,400 or losing about $2,000 is too big for your account because your account is a small account, no worries. Trade the micro E-mini futures, which is a lot smaller. So let me show you that one. Okay, so the E-mini futures, the micro will be /MES. So this is the budget one, the budget futures. So the way you trade it is exactly the same, except instead of multiplying by 50, you multiply by 5. Okay, so again, just look at the active contract, which will be again expiring in March. So everything is the same. Everything's the same, right? So again, let's say we want to trade this one, expiring in 25 days, open it up. So we buy a put at the money, 3760. 3760. Okay, so we're going to buy a put here and sell the put at 3570. Buy this put and sell the put at 3570. Sell this one. Okay, so now one contract will be $44.50 times 5, and that will only be $222, right? So pretty affordable. That if you lose everything, you only lose $200. But if it goes down like you expect, you could make $700. So you're risking $200 to make $700. Again, risking $1 to make $3. But again, in reality, we won't lose the entire $200, right? If it doesn't go our way, we cut loss, we lose maybe $100 or $150. So it's really affordable. The /MES, right? So again, this is the micro E-mini futures, and once you're happy, just send it in and it's going to be in your order. All right. Again, you can always analyze it. Click analyze the trade, and again you get the same thing. You can play around with this purple line and you can see, okay, if I get out on this day, how much do I make, how much do I lose? You have a stop loss, you have a profit target, everything is the same. Okay, so there you are. That's how you trade options on the futures contract. Now, so I'm going to show you quickly now how to place the order on Interactive Brokers. So I've showed you before how to place it on the Interactive Brokers Trader Workstation. I'm going to show you now how to place it on the mobile app, which is a lot easier actually. So we're going to place the same trade. We're going to place this exact same trade, except we're going to do it on the Interactive Brokers mobile app. Okay, so this is my mobile app. I've opened up my Interactive Brokers account. I'm going to click Order Ticket. And you can see I just search. I can either search for /ES. And this would be the S&P E-mini Futures. Okay, so I will choose Futures, Options, Chain, and Combo Builder. This is the one I'll choose because I want to build a combo, which is a spread. Okay, I'll choose this one. So click on this and it will load the option chains. All right, there we are. So just select the same date. So it was the 12th of February, remember? That's the expiration. So we look for 12th of February. We just scroll this. And what I like about Interactive Brokers is that they put down the actual date for you, 12th of February. Whereas for this platform, they just put Friday or Monday or Wednesday, and you got to go figure out the actual day. So there we are. Click on this one. All right. And it should show you all the strikes, and it should load all the puts and calls. It'll take a while to load. So right now it's loading. All right. Now you have to click this on Strategy Builder, right? Turn this on. So this Strategy Builder will allow you to add multiple combos or multiple legs. Okay. Now, if you don't see enough strikes, you want to create more strikes, click on this button here. and you can choose all strikes or 4 strikes, right? So normally I choose all strikes. Time period, you can just leave it as maximum, and class, all classes, right? All classes. In other words, weekly and monthly options, all right? Okay, so going back to this, let's go back to 12th of February. Okay, so 12th of February, expiry date. So we're gonna buy the 3760 put. So 3760 put here. Click ask to buy, click on this. And you can see that first leg appears. So now we sell the 3570. So let's scroll down to look for 3570. Yep, there we are, 3570. So we click bid to sell. So there we are, buy 3760, sell 3570. Okay, so once we've got the 2 legs, click order. And you've built the order. This is a buy order. So again, double check, we are buying the spread, which is buying the 3760, selling the 3570, and this will cost us, right, 1 contract. Right now the market price is 43.50. Again, this is the /ES, so we have to take this and multiply by 50 to get the value of the contract. If you're trading the MES, then we multiply this by 5. Remember? Okay. So this is the market price. Again, you can put your limit order at the market price, or you can bargain by putting it lower. You can, try $43 or $43.25 until it gets filled. Right. So again, this is 1 contract. If you're gonna buy 2 contracts, then just add 2 contracts, 3 contracts, and so on and so forth. So once you're happy with it, right, you've confirmed the order, just slide to buy, and the order will be there until it gets filled. So there you are. That's how you create an order on the IB app. So this concludes our lesson on bear put spreads. We've covered how to create bear put spreads on individual stocks, how to do it on ETFs, how to do it on the SPX index, SPY, ETF, and finally, how do you trade options on the futures contract. I'll see you guys in the next lesson. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.